As you can see on this chart, broadly we break the real estate and banking cycle down into 4 stages. First stage being a recovery expansionary period of 5 to 7 years. Second stage being what's called a mid-cycle recession, roughly 1 to 2 years long. A secondary strong expansion for another 5 to 7 years, and then the bust phase, which usually lasts or on average has lasted 4 years in the past. The portfolio composition during the expansionary phases is largely going to be fully invested in growth assets. So what that means is international shares and Australian shares and property. During the mid-cycle recession, and that's what we've been through, and that's when the portfolio was launched, tactically we were running higher or elevated cash levels just to preserve capital in some more difficult economic and market conditions. And that's exactly what we saw during 2021, 2020, in particular 2022. In that period, the portfolio cash levels ranged between 25 and 50%. The first 2 years of the portfolio's existence, cash levels averaged over 30%. What happened towards the back end of 2022, which is where we were seeing and expecting a transition out of mid-cycle slowdown into the secondary strong expansion phase, the portfolio was moving towards being fully invested. So capital was put into growth assets in second half of 2022, in particular October, November, and by March 2023, the portfolio composition was fully invested for the first time. We would expect, as the secondary expansion continues and develops, that the portfolio will have a largely fully invested profile through that period. As we come into the blow-off phase and the end of cycle, the portfolio will be looking to focus on preserving investor capital. So what we want to do is capture the growth and the upside in the expansionary period, and then preserve capital by holding cash or bonds or other defensive asset classes to weather the storm that will inevitably come as it does at the end of every cycle.